Welcome to the CFO Show. I'm your host, Melissa Howitson, CFO of Venna. Before we begin today's show, I'd like to take a moment to invite you to join me at Accelerate Finance 2025. This year's event takes place in Las Vegas from May 12th to 15th and features a dedicated track for CFOs and aspiring executives, plus keynotes and panels with finance leaders who are redefining what's possible in FP&A. Visit acceleratesummit.com to get your ticket and learn more. Many startups fail within their first 5 years due to running out of cash or failing to raise new capital. This sobering reality confronts numerous young companies and their finance teams. In this episode, we delve into the intricacies of startup finance, exploring everything from managing burn rates to navigating funding rounds. We will examine how to scale financial operations alongside rapid growth while balancing ambitious targets with financial stability. Our discussion will uncover strategies to overcome the financial hurdles that can make or break a startup. Joining me for this discussion is Janelle Gorman, the Chief Financial Officer of York IE, an advisory investment firm for technology companies. Janelle brings a wealth of experience from her roles at TRM Microwave, Oracle, and DIN, where she's been instrumental in driving growth, overseeing major M&A initiatives, and helping startups build strong financial foundations. At York IE, she leads financial operations and works closely with founders on financial planning, operational strategy, and M&A activities. Janelle, welcome to the show.
Thanks so much for having me. I'm excited to be here.
So you've had an interesting path in your career. Can you tell us a little bit about your experience and what brought you to joining York, and also how that influences the way that you advise startups today?
As with many entrepreneurial spirited people, it's a lot of hard work and a little bit of luck. I started my career in public accounting, going the CPA track. And after a few years there, got started with a startup in New Hampshire, which there aren't that many startups in New Hampshire, and really fell in love with the high pace, high velocity, high growth, and bringing kind of old school kind of accounting to something that was really very new school and exciting at a startup, and really fell in love with it there. So I'm sure we'll get into it more, but that kind of learning firsthand how to keep up with an organization that's growing really fast and keep all the nuts and bolts in place of accounting that needs to stay like tried and true was a really fun challenge for me. And I followed that ever since. And that's led me here to York IE, where I get to work with lots of startups that are going through some things I've seen before, some new things, but always exciting in that high growth environment.
It's interesting because I did spend some time working with startups in part of my career. And one of the things I think I love about our profession is that so many of our skill sets are so transferable, be it between industries, different company sizes. You know, you have to learn some of the nuances, but there's a foundation that things also translate so well. So it certainly can be exciting. Now, you get to work with lots of startups today in your role. Curious, what are some of the things that are top of mind for startups right now?
It's been a tough couple of years to be a startup, if we're being honest. We saw M&A markets really slow down. We saw fundraising really slow down. We saw valuations really come down, and perhaps they probably should have. That still doesn't make it an easy time for startups. The top of mind really for startups, I think now, is growth will always be top of mind no matter what the season or trends are. But trying to balance growth in a really challenging economic and market environment is causing a lot of startups to look at cash really closely, ROI on investment, and where they're going to put their very precious dollars and very precious time in order to get that growth without burning cash too fast.
Yeah, it's interesting when you think about where a startup is on the life cycle of a company. Growth needs to remain top of mind. You're trying to prove you have your product market fit, and then you're trying to prove you have your go-to-market fit. Alongside that is the need for fundraising in that world. And so can you talk a bit about how that landscape has changed for startups to raise financing and what you're seeing there?
Yeah, so we look back at, 21, 22, where valuations were, super high. And this idea of like, earn as much as you need to grow as fast as you can. And on the other side of that, you can just raise more funds and your valuation will go up and up because that's what it's supposed to do. That's gone away. That's not been the case, and that's not what's happening. We're seeing that capital is on the sidelines. A lot of investors are waiting to see what happens before they deploy dollars. You could invest in some pretty steady, treasury and get a decent return. So the risk return profile of start investing in startups has really been off. Risk is super high. Return isn't, as high as it had been in the past, or at least not as steadily. What we're seeing now is almost like a change in sentiment for what we know is coming. It almost feels like the worst is over, but we're not sure how fast this resolution is going to come in. So we know that there's a lot of dollars on the sidelines. They're starting to, think about coming in. So we're thinking about investors getting more money into startups, although it's very skewed towards the largest funds that are getting the dollars, right? So it's not, the trickle down effect is still has quite a ways to go. And we're hearing a lot of sentiment about M&A transactions picking up, potentially IPOs picking up, right? Like there's all of this kind of like early rumblings of things that are going to be happening. So there's a lot of positivity and good momentum for the future. I think the question is going to be, how quickly does that play out to actually get dollars into the market and trickled all the way down even to, smaller or less well-connected startups to make sure everybody gets a piece of the pie. So I think we're headed in the right direction. I just wonder about the velocity of getting capital back to startups.
Back in 2020, 2021, it was a different world when it came to fundraising. And there are new challenges being faced apart from just some of the pulling back that's happened in general. But I even think for a startup company now going out in this environment compared to a few years ago, the bar is set, I think, in a different place. So can you talk a bit about what some of those challenges are and how startups should be managing so that they're going to be setting themselves up best to be able to deal with that new environment and the new expectations?
There's a little bit of a double standard that's out there, and maybe it always will be that investors want to see a little bit more safety, a little bit less risk, perhaps, in the checks that they're writing. But there's always going to be a demand for high growth. Those two are kind of competing factors, right? Because you can risk everything and pour a ton of money into stuff and burn cash really fast and really accelerate growth if you make the right bets. But in order to keep a decent cash runway, keep good cash balances so you have the benefit of time, test things out, test out strategies and go to market before you deploy too much capital there. That's going to slow down your growth, right? Whereas if you can just go and put $500,000 to paid ads and digital marketing and hire a couple new AEs and get a new, high power CRO, sure, that's probably going to accelerate growth, but there's a high risk because if those efforts don't land, then you've spent a lot of capital without accelerating that growth. In raising capital these days, there's really the competing factor of those two things, right? Investors are going to want to see that you have the cash runway and decent cash balances that are going to provide you the time that it needs to be successful. And so with that, you kind of have to be a little bit more conservative in your spend, like demand a little bit more of a proven ROI before you really go heavy on investing in some of these initiatives. But you've got to see growth because your valuation is going to be based on growth. It's going to be looking at ARR, how fast are you growing, proven product market fit and acceleration of how big can this company get? I mean, that's a tough answer because it's almost no answer, but startups right now really need to find that careful balance between high growth and a really healthy, financially stable company without going too far that you're like, oh, I'm not investing too much. I'm very safe. I have all this cash runway because that'll slow down your growth. So it's finding that balance that's right for your startup and your investor profile where you're getting decent growth, you're making some bets, but you're getting good ROI on what you're deploying for capital.
As you're saying that, it's making me think about how important then does it become to have some experience at doing this, which again is a bit hard because you can't maybe afford the experience if you don't have the money and spend the money, but having some, hey, I've done this before to de-risk it, or somebody who's proven they can scale and then run a company efficiently, effectively. Is that factoring in or at the startup stage or not so much?
It is a bit, but some people do take it too far. Like we've seen some, startups say, okay, I've got like my first round of fundraising. I really want to get after this. I think I have product market fit. And they'll hire folks that are way too senior for all the experience that they have, or they'll hire like an industry powerhouse for their Rolodex. They'll spend all of their capital on these like really powerful people, but then they don't have any doers, or, they don't have enough doers. Even if those leaders are willing to roll up their sleeves and get to work, a lot of success in the early days is just being scrappy and tenacious and incredibly hardworking and just not giving up when you inevitably fail. So fail, try again, fail, try again, fail, try again. And if you go and hire your initial team just based on experience, say, oh, you've done this before, you can do it again, you're going to end up falling short on these cycles that you have to try and fail. So it's really a balance of, you've got to have someone on the team, a leader or two that knows what they're doing and they know kind of the path. And that doesn't have to be a full-time employee either. That could be an advisor, that could be board members, that could be your mentors, that could be outsourced strategic support. And then you got to make sure that you save enough capital to hire the doers, right? Those people that are just going to get stuff done day in and day out and provide you with the bandwidth that you need to try and fail and try again, all while saving a little bit of money to protect your capital runway, because time is money. And if you spend it too fast, you'll run out of time. And time can be, one of the biggest killers of startups as well. You might be doing the right thing. You just simply run out of time to execute it and build up your customer base. So again, it's really a balance. So have a couple people in the room that know what they're talking about, but be sure that you have, some folks that are just ready to roll up their sleeves and keep at working at it. And that's that kind of like entrepreneurial DNA that you don't necessarily have to have experience for.
It's great advice, because you're right. There is this sense of you're running against the clock, and you've got to get the balance right as you're doing that, of how long do you want to let that clock run and how are you going to navigate that. Now, if you have companies that are starting to think about fundraising as a startup, any advice you have for how they might better prepare for due diligence and what's coming there and going to be looked for?
My answer here will be a little biased, right, from the CFO seat. Of course, you've got to get your product in line, and you've got to get your, product market fit is the first thing that you need before you're ever going to go out and fundraise. If you look at kind of like a pitch deck to go out and fundraise, finance really only gets like 2 or 3 slides out of it, right? You're going to be talking about the product, total addressable market. You're going to talk about the team, because when folks are investing, they're investing in the founders just as much as they're investing in the company or the idea. But from a finance perspective, once you have all of that, which is a huge undertaking, and you're ready to be fundraising, what you want is a really solid financial plan that isn't pie in the sky and hopes and dreams, right? And I want ARR to be double, triple, because that's the good story to tell. But actually get a financial plan under that quantitatively validates that your qualitative goals and plan are achievable, and it gives you a path to get there. So when we talk about balance of growth and, capital, it's really that financial plan that puts it together to say, here's everything I want to achieve. Here's the capital I have and the capital I'm asking for. Here's what I'm going to do day to day, month to month, and how I'm going to pay for it in order to get to these financial outcomes. Strategy goes first when you start to fundraise. How much do you want to raise? What are you looking at for, valuation? What's your appetite for dilution? How much runway are you really needing? What are the plans? Where are you going to invest those dollars? All those kind of high level questions need to be answered. And then you can really start to put the puzzle pieces together of your financial plan to say, okay, I said that, I'm raising so I can have a great go-to-market because I do want to double my ARR. So that means I'm going to need a revenue leader. I'm going to need a couple sales folks. I need a marketing plan. If I can do all of that, I can create this lead volume, these meetings that can turn into these closed won deals at this average selling price. And so you start to throw all of these like detail pieces into the puzzle. You can play around with it to see if it fits, right? When you're initially like, oh, I was going to raise $5 million, but this plan is only saying that I need 2. Or I was going to raise $2 million, but the plan I just put in place said I'm going to need 10. And so it's really going to be an iteration of high strategic goals and assumptions, get down to the details, see if you can build a bridge to make them work. And you iterate the high level goals and the details until you can kind of get to a place where you have a bridge. of a quantitative plan that gets your qualitative goals. So it can be quite a process. It's very iterative.
That can feel hard to do when there's not a ton of data points. You can do more than you think in terms of, hey, what would these assumptions need to look like? Can I validate? Where can I validate these points? And what is the risk or the tolerance for the up and the down scenario, the mid scenario, just to know the waters that you're even in as you're going out and showing confidence that you understand your market, you understand what these different driving assumptions will be in the plan. So I think that's great advice because the iterations are key.
One of the risk factors that we see in folks going out to fundraise, they'll get their product market fit, they'll get their go-to-market plan, they've got their team leaders, they know what they want to accomplish. And then they'll say, let's just raise some money and see what we can do with it. We'll just have a best effort. Let's try not to spend too much. Let's try to achieve bookings as best we can, and hopefully revenue will flow to make the finances work. And that's the most dangerous thing you can do, right? Is best effort planning, because inevitably things will go sideways. Teams will get sidetracked. One leader might spend way too much. Another leader might not spend nearly enough. And so by letting a company go off with their interpretation of what the best effort to try to achieve their goals is, you end up with really disaggregated efforts. You're going to burn a lot of time and a lot of money in doing that. So I would just really, encourage all founders and entrepreneurs as they're going to fundraise. Don't just think that $5 million check will be enough to fund what you need and you'll do your best as you go. That initial plan is really critical in figuring out how you'll deploy it and where it'll get you, and holding accountable to the plan as you go. So if and when you inevitably need a pivot, you have the information to do that.
Let's move over into scaling the finance team, because you've had a lot of experience with that. What do you think are some of those key components to scaling the finance function in a startup?
Initially, you've got to get your nuts and bolts of accounting locked in. Sometimes people stop there, so we'll make sure that to keep going with building out the team. But most startups start with a very cash basis way of operating. Collect the money from customers, pay payroll, pay the bills, keep everything alive, right? It's just very cash as the blood of the business, pumping in and out and keeping everything moving. Initially, just a great bookkeeper and a great tax accountant is critical, so you know that your information is correct. Most oftentimes in startups, that can be outsourced because it's not going to be a full-time job from the start. So it's probably part-time or outsourced work that you can get. I believe very strongly in fractional and outsourced resources for startups throughout the business, because in a world where you can't afford to hire a team of 20, to get all of your functions built out, you could probably afford to hire a team of 5 and then build out the fractions of resources that you need in order to get all of the functions covered without having a huge payroll. And so for the finance team, what that might look like is maybe a bookkeeping service that comes with kind of bookkeeping and account management. So you have the bookkeeper day to day, and then there's a manager there that jumps in just for a few hours a month to do the analysis for you, kind of figure out reports and deliver that back. As you get into strategic planning, some CEOs might have a mind for business and finance, and so they might be able to get a forecast going with an outsourced resource or an advisor or somebody, and then be able to maintain it throughout the year. But I think it's important for founders that don't have that business savvy, especially really heavy tech founders, know that about yourself and get a kind of business partner. The finance team in early days is probably going to extend into HR and IT and contracts and business systems. All of those things are really important. They play well with finance because that's where a lot of the cost drivers are going to be in your early days. So finding a business partner in your finance function, I think, is critical. So I'd say if you're going to start really with okay, I'm going to hire 2 people, or maybe they're outsourced and really lock that in. I would say your bookkeeper and your tax accountant outsourced, and then maybe a controller level is important to start. Someone that can flex up to some more strategic stuff, but also kind of get their hands dirty in making sure that the books are running tidy and keeping an eye on cash. Cash forecasting in the earliest days is really important to understand where that's going. And then as you grow and evolve, you start to bring on more of that strategic component, especially as your forecast gets a little more complex. At York IE, we kind of offer that outsourced finance function end to end. And I'm sure there's other organizations that do, but that can be a really great fit because you get kind of the pieces of the puzzle that you need and just the volumes that you need them.
It's so critical. And it's true of many of the roles in a startup is you do that need to be scrappy, roll up your sleeves. You want to cover the strategic, but you got to also get the work done. And so finding the right mix of fractional or even the mindset, I think, of the individuals that you're going to be bringing in, they, really got to know what it is they're getting into and put together the right complement. So I think that's some great advice. What are some of the metrics that you think are most critical for startups to be looking at?
So if we're kind of looking at post product market fit, maybe this startup has raised some funds and they're starting their go-to-market effort. That's when we like to see kind of the biggest growth area, when you can start to be a little less scrappy and really start to be a little bit more strategic in your financial analysis. And so a lot of the ones that I like there for that really critical stage of startups are customer acquisition costs as it relates to lifetime value of a client or a customer. So customer acquisition costs are anything you spend on sales and marketing, all your go-to-market efforts, right? What are you spending to try to acquire new customers? You want to compare that to some measure of what you're getting back from those clients that you spent that money to go and acquire. And there's a few ways of looking at that. So lifetime value is going to kind of estimate how long a customer stays with you and what they're going to spend with you over the lifetime that they're a customer of yours. I love that metric. CAC to LTV is what it's called. That can be hard to measure if you're very new and you don't know the lifetime of your client, right? So if you've only been in business for 3 years, you don't know how long your customers are going to be staying on the platform. Maybe forever, who knows? But you don't quite have that churn data yet. So one that I like to look at for the earlier stages is CAC payback period. So that looks at your customer acquisition costs, and it's going to take a look at the average contract value. And I usually adjust it for gross margin to say, how long will it take for that client, your customer, to be a customer of yours in order to pay back what you paid to get them. And you want that CAC payback period to be 1 year or less. Of course, the smaller it can be, the better, right? But in startups, what we see a lot of times is they'll invest so heavily in go-to-market for subscription-based. Sometimes that ARR can be really small. So if they're spending a lot on go-to-market in a big team, and they're only getting, say, 10 new clients a month at a average contract value of $1,200 a year, it could take them 3 years to earn back what they spent on bringing those clients in because they're just not getting the volume. It's a really great indicator that you have some inefficiencies in what you're spending. Either you need to spend less because the volume that you're getting is what it is and you're just wasting money on go-to-market that's not reaching your target audience, or you need to kind of adjust how you're spending on your go-to-market or take a look at your sales process to say, if we're spending this much money on go-to-market, we should be bringing in a lot more clients. So it's a good indicator that something's a little bit broken there. So you can go in and figure out what's going on with that go-to-market motion, why the spend isn't really connecting with the audience as it should be.
I am also a big fan of that metric because it helps you to keep it real. Because you'll often hear, we're not spending enough. Oh, we're spending too much. And it just helps take some of that friction even out of those conversations as you're trying to figure out what is the right balance that we're going to get and how are we going to measure it. Now, we talked a bit earlier about how early stage companies figuring out your cash flow and managing that. Do you have any advice for how startups should most effectively try to manage the cash flow?
I like to take a two-pronged approach. Cash, we know, is inherently difficult to forecast. And it's the thing that people want to know the most, right? They want to know two things. What's my ARR going to be? And what's my cash balance going to be? And those are really difficult because there's so much variability that's involved in cash. What are you going to book? How are clients going to pay, right? Annually in advance, monthly, whatever the case may be. Are they going to pay on time? So are you just charging their credit card or are you sending them an invoice? And now it's up to them when they send in the money. So money coming in is subject to timing. That's really hard to predict. Money going out is subject to timing. That can be really hard to predict too, right? Because you'll have, okay, we're going to spend this year. Well, did one of your leaders go out and negotiate better terms from payment in advance? And so now you have cash going out the door when you expected it might be monthly, but you have it all upfront right now. it becomes really hard to predict, but critical to predict. So my approach that I like to take is when I'm doing a financial forecast, I'm going to look at a 12-month period. For the P&L is where I'm really going to start, but then I want to do a 3-statement forecast. So I want to take those assumptions and I want to build out a forecast for my balance sheet and my statement of cash flow. The best way to do that is really to be making assumptions on AR and AP and deferred revenue based on historic trends or your best idea of what your collection terms are going to be, how much deferred revenue you'll have if you do annual in advance, and then what your payment terms are going to be on AP. So that'll give you a really overarching, if we spend like this year, and our customers pay us and we pay our vendors generally like this year, this is where cash should end up. It's going to give you a good long-term view. But day to day, it's not going to tell you how much you're going to have in your bank. So I like for early stage startups that manage cash really closely, I like to add on a direct cash flow model. It's a completely separate model, actually, like a different file, but it's very direct, cash in, cash out. And this plays well with founders that are not business savvy, especially like our tech founders that are like, I don't understand what you're talking about with deferred revenue or AR or AP, whatever those stand for. How much money is going to come in this week and how much money is going to go out this week? And so I usually keep those up for about a 12-week rolling period to say, here's what customers owe me and when I think each of these customers are going to pay. Here's what I owe for AP and when I think I'm going to pay it. And then here's kind of a more granular assumption around my recurring expenses and when I pay them and deals I know that are about to come in and I can bill them shortly in the future. So having both of those views, I think, is really important. It is a bit of work, right? But in my experience, I found it's incredibly worthwhile because the alternative really is that you open up the bank account, see what the balance is, and hope for the best. And as we know, best effort strategy will get you into a lot of trouble.
Your recommendation helps make it easy for others in the business to understand because it's not always clear to them why the terms matter. The payment terms they're negotiating with our vendors, with our customers. But when you start to see, money in, money out, like everyone balances their finances at home, you hope. And so they start to realize and payroll is one of the most key pieces of that. The timing of your payroll is non-negotiable. You're going to have to pay your employees. And so even seeing how that factors in amongst these other things is a really good way to go. So I think that's some great advice and just continuing to reconcile sort of a big picture with a more detailed near-term picture. So you've got a real handle on how the different dynamics are playing out. It also helps, I think, inform those broader assumptions as you're going because you keep learning in that 12-week cycle and then being able to adjust. There are these inherent uncertainties when you're doing overall planning for a startup. And so what advice do you have for going about the overall planning for the business?
It's a bit of that same approach from cash. It's a pivot of looking at high level and then very detailed. You need to have a high level plan and a high level strategy for your leadership and your entire company to get behind, right? We want to grow ARR to 3 million this year. That's going to mean something to a lot of different folks, right? Your product team needs to know what that means for them for product development. Your marketing team needs to know what that means for them, your sales team, and so on. And so really kind of aligning at those high-level strategic goals will then kind of allow everybody to say, okay, what do I need to do on a detail basis that will lead the company to get to this high-level outcome? And so from a finance perspective, we've got to do that too. And really, the finance seat needs to partner with all of those other leaders in the business to help them with theirs because they're going to have dollars associated with all of the work that they do. And so finance needs to truly be a business partner to all the leaders in the room to help them see the bridge from that strategic to detail level plan.
And you've had lots of experience with different companies. In your opinion, what is it that differentiates some of the successful startups from those that are less successful? What are some of the common pitfalls that companies fall into?
It's easy, especially in startups, and for mature organizations as well, to try to take on too much. So just because there's an opportunity to do something, to hire that new person or go for that new product line or try out, a series of new conferences, it doesn't mean that that's the right thing to do. And so as a company, you're forced to say no to some really great looking opportunities so that you can stay on track with what your core goals are. That's really hard to do, especially as a startup when you have a lot of enthusiasm and big dreams for what the company can be. Like, ooh, I wasn't planning on that, but that could be really cool and that could be really cool. By saying yes to those things, you're saying no to your core strategy. And that's a mistake that will always cost you dearly. So one thing that founders really have to be aware of is like, pick your 3 things you're working on this year and only say yes to opportunities that align to those things. Shiny objects can be really dangerous for a startup.
It is so hard to say no when you're in that mode and you're trying to do that building. So I think that is great advice because it's definitely an easy trap to fall into. In your career, you've had some great experience, and now you're able to advise more broadly to many companies and offer services as a fractional CFO. For some of our listeners who may be listening and thinking that that's eventually something that they would like to do, what advice would you have for them?
It goes back to what you said actually in the beginning, where accounting is very transferable, finance is very transferable. It's almost like a language, that you can kind of fit into any particular business. So I think if folks are thinking like, wow, that might be exciting to, be helping founders and be sharing their learning experiences, really think about kind of the commonality of your skill set and your background that could help any business kind of get through this stage. And then what are your passions? Advising startups is not for the faint of heart. I kind of sometimes laugh at our organization a bit. I'm like, we're startup, investing in startups and advising startups. Like, do we just not like sleep? Do we love stress? What is this? But it's kind of taken reflection on, getting out of that day-to-day battle and kind of the fighting fires that startups can be, and really kind of figuring out like, what have you done as a CFO in the past that's worked, that's really led the business in the right direction? What stage do you like to work with? What kind of like founders and teams do you like to work with? And so if you find that you kind of have a knack for something, you can go and like develop a client base on that. That's really rewarding. So, as much as I might make fun of, how stressful startups are, and I simply can't seem to escape them, it's because I love it. I think SaaS is really cool. I'm very familiar now with the KPIs, some of the struggles that they might see, the fundraising conversations and approaches that tend to work. Things are always changing. There's always something to learn, but I just kind of discovered a passion for that, which I've been able to turn into a set of skills related to that passion. And once you have that, then people are happy to take your advice because, it's valuable. You've been where other people haven't been, and you've put kind of effort into that overall strategic approach where other folks are spending their days fighting fire. So once you can identify what that is, your passion is, nurture the skills that are under that, people are gonna want to leverage your expertise.
If you had to give just 3 pieces of advice to startup companies, what would it be?
My first piece of advice would be to surround your startup with great people. So we know like culture is going to be everything. And even from a CFO perspective, payroll is going to be your biggest expense, right? So we know like the people that are in the startup are really critical. But even outside of that, you want to surround your startup with advisors, mentors, peers, even sometimes competitors that, like can have some insights. Surround yourself with the right people that can give you advice, guidance. They've been there, they've done that. Don't try to do it alone. You won't be able to afford to hire all the people that you'll need to help you. Startups will simply run out of money. So the more relationships you can make with advisors, podcasts, go to webinars, go to startup events, I think that's really important, and can make a really meaningful impact on the success of the startup. I would say second piece of advice is to be really pragmatic in your growth. There's a lot of shiny objects that will come up for a startup, and founders are, as part of their DNA, they're excited, they're motivated, and they see a huge vision for the future. So it can be easy to fall for things that you think could be additive. So really kind of keeping your feet on the ground while your head is in the clouds for that grand vision, it stretches a founder, but both are really important. So really, flexing your no muscle when it needs to be, or at least, saying, that's a great idea for later and put it on a shelf is really important. The last one I'll say is product market fit, I guess, right? Mm-hmm. Like that's the step 1 to being successful. And so a lot of times in that eagerness and that tenacity for achieving the vision, founders can skip that a little bit, or there's actually a lot of steps they can skip, right, in anticipation. But the one that you simply cannot skip is product market fit. Don't try to go for your go-to-market launch and your full scope investment in selling this thing until you're sure that you have product market fit. Because if you don't have it, you're not going to get as far as you need to. And you might have to backtrack to get it and then restart. And that can burn a lot of cycles and cash.
Janelle, thank you so much for joining me today, for sharing your advice. Now, whenever we do have a guest on the show, we have 2 rapid fire questions we like to ask. So are you ready?
I am ready.
What is the hallmark of a mature finance team in terms of how they operate?
Clarity on data and alignment with the full leadership org is how you can know that your finance team is running tip top. Because in order to have crisp, clear data, KPIs, financial reports, you get the same report on every month, and it's really usable. There's so many things that happen in the foundation of that. It means that your financial data is accurate. It means that it's timely. It means that you've talked to your leadership team about what's important for them to know. And you've really kind of nailed, like, this is how we do things. And so when you have clarity and alignment in your financial data, you've done a lot of things right to get there.
The second question that we have is, what helps you to turn a bad day around?
It's always connecting with my team, really. A couple of weeks ago, I was sick. I was working at home. And by Friday, I was like, dang, this is hard. I was just kind of like in a grouchy mood and, getting stuff done, but just trying to get through it. And then when I can come to the office and see the people that I'm working with, it reminds me of the connection, why we're doing this. I'm not doing this alone. Other people are here to help. My problems probably aren't as serious as they feel when I'm by myself. So if I need to turn a bad day around, I'm going to get a cup of coffee with somebody I work with and just connect.
Such great advice. Thank you so much. Appreciate you sharing your insights, your passion. I've really enjoyed this conversation with you today.
Thanks so much, Melissa. It's been great. I appreciate you having me.
Want to learn more about today's discussion? Check out the resources in our show notes. Don't miss out on future episodes. Subscribe to the CFO Show on your favorite podcast platform. For the CFO Show, I'm Melissa Howitson. See you next time.